Listen up, because what I'm about to tell you is going to save you from financial disaster. I'm Kevin O'Leary, Mr. Wonderful, and I've made billions by knowing when to hold, when to fold, and when to run from bad investments. Right now, I'm watching people, maybe you, make the dumbest financial mistakes I've ever seen. They're throwing $10,000 into investments like they're playing slots in Vegas. And you know what? They're going to lose. Every single penny. Here's the truth. Nobody wants to tell you. 90% of investors are doing it wrong. They're following gurus on YouTube, buying whatever's trending on Reddit, or worse, investing in their cousin's can't-miss startup. It's insanity. I've sat across the table from thousands of entrepreneurs. I've deployed hundreds of millions of dollars. I've seen fortunes made and destroyed. And I can tell you with absolute certainty, if you invest that $10,000 without watching this entire video, you're making a catastrophic mistake. This isn't clickbait. This isn't hype. This is reality. Your financial future is on the line, and I'm about to show you exactly what Wall Street, the banks, and the so-called experts don't want you to know. Let me ask you something. Do you know what $10,000 really represents? It's not just money. It's 500 hours of work at $20 an hour. It's 6 months of saving. It's your family's security. It's your future. And right now, millions of people are throwing it away. I see it every single day. People come to me and say, Kevin, I invested $10,000 in crypto, or Kevin, I put everything into meme stocks, or my personal favorite, Kevin, I invested in my friend's business idea. You know what I tell them? You're a fool. Here's what nobody tells you. The investment industry is designed to take your money. Mutual fund managers charging 2% fees while underperforming the S&P 500. Financial advisors who get kickbacks for selling you garbage products. Crypto exchanges that go belly up overnight with your money. It's a rigged game, and you're the sucker at the table. But here's the thing, I'm not here to tell you not to invest. I'm here to tell you how to invest that $10,000 so you don't end up broke, bitter, and blaming everyone but yourself. The biggest lie in investing. Wall Street wants you to believe that investing is complicated. They use fancy terms like algorithmic trading, derivatives, hedging strategies. Why? Because if you think it's complicated, you'll pay them to do it for you, and they'll charge you an arm and a leg for the privilege of losing your money. I've been doing this for 40 years, and I can tell you, investing is not complicated. It's simple. But simple doesn't mean easy. There's a difference. Here's the truth. Before you invest a single dollar, you need to understand 3 fundamental principles. Miss even one of these, and you're dead in the water. Principle Hasson. Know your number. Most people have no idea what their money needs to do for them. They just throw money at investments hoping for the best. That's not investing, that's gambling. Before you invest $10,000, answer this question. What do you need this money to become? And by when? Are you 25 years old saving for retirement? That $10,000 needs to grow for 40 years. Compound interest is your best friend. You can afford to take calculated risks. Are you 55 years old and need this money in 10 years? Different game entirely. You cannot afford to lose it chasing moonshots. Are you trying to generate passive income now? Then growth stocks are useless to you. You need dividend-paying assets. See the difference? Your age, your timeline, your goals, these determine everything. And if you don't know your number, you've already lost. Principle #2. Diversification is your only defense. I cannot tell you how many people come to me with their entire net worth in one investment. One stock, one property, one business, and they look at me like I'm the crazy one when I tell them their idea. Here's a fact. Even the smartest investors in the world can't predict the future. Warren Buffett can't. Ray Dalio can't. I can't. Nobody can. So if you think you can pick the one winning investment, you're delusional. Diversification isn't about being scared. It's about being smart. It's about making sure that when, not if, but when one of your investments goes south, you don't lose everything. The right way to deploy $10,000? You spread it across multiple asset classes, stocks, bonds, real estate, maybe a small percentage in alternative investments. You don't put it all on black and spin the wheel. But here's where people screw up diversification. They think owning 10 different tech stocks is diversification. Wrong. That's concentration with extra steps. Real diversification means different sectors, different asset classes, different risk profiles. Principle #3, emotions will destroy you. This is the one that kills more investors than anything else. People are emotional about money. They panic when markets drop. They get greedy when markets soar. They make decisions based on fear and greed instead of data and logic. I've watched brilliant people, doctors, lawyers, engineers, make the dumbest investment decisions because they let their emotions take control. They buy high because everyone else is buying. They sell low because they're scared. It's the exact opposite of what you should do. You want to know the secret to successful investing? It's boring. It's disciplined. It's emotional. You set a strategy based on your goals, you stick to it, and you ignore the noise. When the market crashes, and it will crash, you don't panic, you rebalance. When everyone's euphoric and buying garbage at inflated prices, you're cautious. You do the opposite of what your emotions tell you to do, the red flags you're ignoring. Let me tell you the warning signs that you're about to make a terrible investment with that $10,000. Someone's promising guaranteed returns. There are no guaranteed returns except U.S. Treasury bonds, and those barely beat inflation. Anyone promising you 20%, 50%, 100% returns guaranteed is either lying or running a scam. You don't understand the investment. If you can't explain how an investment makes money in one sentence, you shouldn't invest in it, period. You're investing because of FOMO. Fear of missing out is not an investment strategy. It's emotional weakness. There's pressure to act now. Legitimate investments don't have timers. If someone's pressuring you to invest immediately, run. You can't afford to lose it. If losing this $10,000 would devastate you financially, you shouldn't be investing it. You should be building an emergency fund. Here's the bottom line for part one. That $10,000 in your hand is a test. It's testing whether you're smart enough to build wealth or dumb enough to destroy it. Most people fail this test. Don't be most people. Now that you understand the principles, let's talk about where you should and absolutely should not put that $10, 000, because the investment landscape today is more dangerous than it's ever been. I've been investing since the 1980s. I've seen the dot-com bubble. I've seen the 2008 financial crisis. I've seen crypto mania, and I can tell you, right now is one of the most treacherous times to be an investor. Why? Because there's more garbage disguised as opportunity than ever before. Social media has created an army of fake experts. Technology has made it easier than ever to lose money. And human greed? That hasn't changed one bit. The crypto trap, let's start with the elephant in the room. Cryptocurrency. I own crypto. I believe in blockchain technology. But if you think throwing $10,000 into Bitcoin or some random altcoin is a smart investment strategy, you're wrong. Here's what the crypto bros don't tell you. Cryptocurrency is speculative. It doesn't produce cash flow. It doesn't pay dividends. Its value is based entirely on whether someone else will pay more for it tomorrow than you paid today. That's not investing, that's speculation. Now, does that mean you should avoid crypto entirely? No. It means you need to be smart about it. If you want exposure to crypto, fine, allocate 5% of your portfolio, maybe 10% if you're young and aggressive. But $10,000 all in on crypto, that's financial suicide. I've seen people lose everything in crypto, not because crypto is inherently bad, but because they treated it like a lottery ticket instead of a calculated risk. They bought at the peak, they panic sold at the bottom. They got wiped out by exchange failures. They fell for pump and dump schemes. If you invest in crypto, do it with money you can afford to lose, because there's a real chance you will. The stock market, opportunity or trap. The stock market has created more wealth than any other investment vehicle in history. It's also destroyed countless fortunes. The question is, which side will you be on? Here's what most people get wrong about stocks. They think they need to pick the next Amazon or Tesla. They waste time studying charts, following tips, chasing hot stocks, and they lose. The data is crystal clear. Over any 2 0-year period, the S&P 500 has never had a negative return. Never. But individual stock pickers, 90% of them underperform the market. So here's what you do with stocks. You buy index funds. You get broad market exposure. You let compound interest do the heavy lifting. It's boring, it's unsexy, and it works. But Kevin, people say, index funds only return 10% a year. I want bigger returns. Sure you do, and I want a unicorn, but wanting something doesn't make it realistic. That 10% annual return, compounded over decades, will make you wealthy. But you know what you need? Patience. And most people don't have it. They get bored. They start stock picking. And they blow themselves up. Now, if you absolutely must pick individual stocks, follow my rules. Only invest in companies you understand. If you don't know how they make money, pass. Look for competitive advantages. What makes this company special? Why can't competitors copy them? Check the financials. Is the company actually profitable? Does it have manageable debt? Never fall in love with a stock. It doesn't love you back. Be willing to sell when the thesis changes. Real estate. The forgotten wealth builder. Here's something most financial advisors won't tell you. Real estate has created more millionaires than any other investment class. Why don't they tell you? Because they can't charge you fees on real estate you own directly. But here's the challenge. $10,000 isn't enough to buy investment property outright in most markets. So what do? Option 1, REITs, real estate investment trusts. These are companies that own and operate real estate. They trade on the stock market like stocks, but they're required to pay out 90% of their income as dividends. You get real estate exposure with stock market liquidity. Option 2, crowd-funded real estate. Platforms let you invest in real estate deals with as little as $500. You're pooling your money with other investors to buy properties. Returns can be solid, but make sure you understand the risks and fees. Option 3, save and invest elsewhere until you have a down payment. If you're serious about real estate, maybe that $10,000 is the start of your down payment fund, not an investment you deploy today. Real estate is powerful because of leverage. You can control a $200,000 property with $40,000 down. If it appreciates 5%, that's $10,000 in equity, 25% return on your cash. Plus rental income, plus tax benefits, it's a wealth building machine. But, and this is critical, real estate is not passive. It requires work, knowledge, and risk management. Don't believe the guru selling you on passive income from real estate. It's active income with passive potential if you do it right. The business investment nightmare. This is where I see the most money destroyed. Someone's brother-in-law has a can't-miss business idea. Someone's friend is starting a restaurant. Someone saw on Shark Tank that investing in startups makes you rich. Let me be brutally honest. Investing in someone else's small business with your $10,000 is one of the worst things you can do. Here's why. 90% of startups fail. Within 5 years, you have no control over the business. You'll likely lose your money and damage relationships. There's no liquidity. You can't sell your stake easily. Most small business owners don't know what they're doing. On Shark Tank, I invest in businesses. But you know what? I have expertise. I have resources. I have leverage. I can ADD value beyond just money. And even with all that, most of my deals don't work out. You, investing $10,000 in your buddy's business, you're a piggy bank, nothing more. And when the business fails, and it probably will, you'll lose your money and your friendship. If you absolutely must invest in a business, make sure, 1, you understand the business model completely. 2, there's a clear path to profitability. 3, you're prepared to lose every penny. 4, you get proper legal documentation. The bond market. Boring but essential. Bonds are the vegetables of investing. Nobody gets excited about them, but they're essential for a healthy portfolio. Here's what bonds do. They provide stability and income. When stocks crash, bonds usually hold steady or even go up. They're your portfolio's shock absorber. With $10,000, you should have some bond exposure, especially if you're over 40. The old rule was your age in bonds, if you're 30, have 30% in bonds. I think that's too conservative today, but the principle holds. You need some stability. The challenge right now, interest rates have been all over the place, and inflation has eaten into bond returns. But that doesn't mean you skip bonds entirely. It means you're strategic about which bonds you buy. Short-term treasury bonds are essentially risk-free. Corporate bonds pay more but have credit risk. Municipal bonds offer tax advantages. Build a diversified bond portfolio that matches your risk tolerance. All right, we've covered the principles and the pitfalls. Now it's time for the action plan. This is the part where I tell you exactly what to do with that $10,000. Pay attention, because this is where most people fail. They learn but don't execute. The pre-investment checklist. Before you invest even $1, you need to complete this checklist. Skip any of these steps and you're setting yourself up for failure. Step 1, emergency fund. First, do you have 3 to 6 months of living expenses saved in a high-yield savings account? If the answer is no, that $10,000 doesn't get invested, it goes into your emergency fund. I don't care how good an investment opportunity looks. If you don't have an emergency fund and something goes wrong, you lose your job, your car breaks down, you have a medical emergency, you'll be forced to sell your investments at the worst possible time. You'll lock in losses. You'll pay taxes and penalties. You'll destroy your financial future. Emergency fund first, investments second. Non-negotiable. Step 2, eliminate high interest debt. Are you carrying credit card debt, auto loans above 7%, any debt over 8% interest? Here's some math that will blow your mind. If you're paying 18% interest on credit card debt, paying off that debt is an instant 18% return. Show me an investment that guarantees 18% returns. You can't, because it doesn't exist. Pay off high interest debt before investing. It's the highest return investment you'll ever make. Step 3, maximize tax, advantaged accounts. If you have access to a 401k with employer match and you're not maxing out that match, you're leaving free money on the table. That employer match is an instant 50% or 100% return. After that, max out a Roth IRA if you're eligible. That $10,000 growing tax-free for decades is worth way more than the same money in a taxable account. Tax efficiency is the secret weapon of wealthy investors. They're not just thinking about returns, they're thinking about after-tax returns. The optimal $10,000 allocation. Assuming you've completed the checklist, here's how I would allocate $10,000 today. This is based on someone in their 30S, 40S with moderate risk tolerance. Adjust based on your situation. 4-0 US stock market index funds, 40%. Put this in a low-cost S&P 500 index fund or total stock market index fund. Vanguard, Fidelity, Schwab, they all offer excellent options with fees under 0.1%. This is your growth engine. Over 30 plus years, this will likely be your highest returning asset. Don't touch it, don't trade it, just let it compound. $2,000. International stock index funds, 20%. The US is amazing, but it's not the only game in town. International diversification protects you if the US market underperforms. Look for developed international funds, Europe, Japan, Australia, and consider emerging markets for higher growth potential and higher risk. $1,500. Bond index funds, 15%. This is your stability. When stocks crash, and they will, bonds provide a cushion. They also generate income. Consider a mix of government bonds and investment-grade corporate bonds. Keep the duration relatively short, 5 to 7 years, to reduce interest rate risk. $1,500. Real estate investment trusts, 15%. REITs give you real estate exposure without the hassle of being a landlord. Look for diversified REIT index funds that own different property types, apartments, offices, retail, industrial. Real estate often moves independently of stocks, providing additional diversification. $500. Alternative, speculative investments, 5%. This is your play money. Want to invest in crypto? Fine, 5% won't kill you if it goes to zero. Want to buy individual stocks? Go ahead, but keep it small. This allocation lets you scratch the itch to take risks without destroying your portfolio if things go wrong. $500. Keep as cash reserve, 5%. Keep this liquid in a high-yield savings account. This gives you the flexibility to take advantage of opportunities or handle small emergencies without disrupting your investment strategy. The rebalancing strategy, here's what separates winning investors from losing investors. Discipline. Once a year, you rebalance. If stocks have done well and now represent 50% of your portfolio instead of 40%, you sell some stocks and buy bonds or REITs to get back to your target allocation. This forces you to sell high and buy low automatically. It's counterintuitive. You're selling what's doing well and buying what's struggling, but it's how you manage risk and capture gains. The mistakes to avoid. Now that you know what TO do, here are the fatal mistakes to avoid. Mistake Hasson. Checking your portfolio daily. Obsessing over daily market movements is how you make emotional decisions. Check quarterly, rebalance annually. That's it. Mistake #2, trying to time the market. Nobody can consistently time the market. Not professionals, not algorithms, not you. Invest systematically and stay invested. Mistake #3, chasing performance. Last year's best performing investment is rarely next year's winner. Stick to your allocation instead of chasing hot returns. Mistake hash 4, investing money you'll need soon. Money you need within 5 years doesn't belong in the stock market, period. Stock markets are volatile, short-term, but reliable long-term. Mistake hash 5, failing to increase investments. That $10,000 is just the start. The real wealth comes from consistent contributions over decades. Set up automatic monthly investments, even if it's just $100. Consistency beats timing. Here's what nobody wants to hear. Investing that $10,000 wisely won't make you rich overnight. It won't buy you a Lamborghini next year. It won't let you quit your job. What it will do is set you on the path to financial freedom. That $10,000, invested properly and added to consistently, can become $100,000 in 20 years, $500,000 in 30 years, over $1 million in 40 years. But only if you're smart, only if you're disciplined, only if you follow the plan instead of chasing get-rich-quick schemes. The choice is yours. You can be part of the 10% who build real wealth or the 90% who stay broke chasing dreams. I've given you the roadmap. The question is, are you disciplined enough to follow it? This is Kevin O'Leary. Stop being stupid with your money. Start being strategic. Your future self will thank you. Now get out there and make it happen.